Hi everyone, thanks for joining in. This is your weekly market outlook for the 20th to the 24th of February 2023. Let's take a look at what's been going on last week. We've got the US CPI number, year-on-year beating consensus, coming in hot at 6.4%. Previous was 6.5% and consensus was at 6.2%. US core CPI year-on-year at 5.6%. Previous was 5.7% and consensus was at 5.5%. US CPI month-on-month at 0.5%, previous was 0.1%. US core CPI month-on-month at 0.4%, previous was 0.4%. The US retail sales number from last week also at all-time high, with year-on-year retail sales at 6.4%, previously at 5.9%. US month-on-month retail sales coming in at 3% versus a consensus of 1.8%. Month-on-month core retail sales coming in at 2.3% versus 0.8%. Now, with the retail sales at all-time high and unemployment at 43-year low and inflation falling less than what market expects, it's really weighing on risk sentiment in the market, on the assumption that the FOMC could be more hawkish given its current situation. And market is basically awaiting the FOMC meeting minutes for this week. We also have the UK inflation remaining above 10% at 10.1%, previously at 10.5%, and consensus was at 10.3%. So it is slightly lower than what the consensus is. Core CPI also fell to 5.8% from 6.3%, and that's also below the consensus of 6.2%. So unlike the FOMC and the ECB, market is currently expecting the Bank of England to hike another 25 basis points, and then they might pause given the current rate of falling inflation. All right. So with that, let's take a look at what's coming for this week. Okay, so we already have the release of the RBA meeting minutes. They did mention a little bit about the 50 basis points consideration. So they did consider that, but they went with the 25 basis points. In terms of data's coming out on Tuesday, we've got the Canadian inflation numbers. That's going to be on Tuesday. I think what's key would actually be on Wednesday for the FOMC meeting minutes. Again, very similar to the current situation with the RBA meeting minutes on Tuesday, awaiting to see if there's actually any discussion on hiking 50 basis points in the previous meeting by the FOMC, and if they do consider that, then it might actually send a little bit more of a hawkish tone into the market. Okay, on Tuesday as well, there's the flash PMIs numbers, manufacturing and services PMI numbers from the Eurozone as well as the US. The expectation is that the numbers are likely going to be very close to 50, but what we're waiting for really is more if there's actually any surprise coming out from the US manufacturing PMIs and the services PMI. The current number is at 46.9. The expectation for the release on Tuesday would be at 47.1 for the manufacturing, and for the services from 46.8 to 47.1 as well. So if there's any surprises to the upside, it would mean that the PMI, both manufacturing and services, needs to be above 50. That would actually trigger a surprise that could actually strengthen the US dollar. So that is basically what the market is waiting for. Also on Friday, we've got the Japanese inflation rate. The year-on-year headline inflations are expected to come in at 4.2%. The core inflation rate also to 4.2%, a jump up from 4%. Also, just to wrap up the week, I think the market is waiting for the PCE numbers, personal consumption expenditure, on Friday. That's coming out from the US, to see if there's actually going to be any signs of inflation returning into the financial world. Okay, all right, moving on, let's take a look at the dollar index here. We have the dollar index pretty much finding resistance at 104.50. That's basically the 78.6% Fibonacci retracement. So the current retracement is still between 61.8 to 78.6%. Now, given the current situation, it would indicate that the dollar index is yet to indicate any bullish momentum at this point in time, because it's kind of full. It's between 61.8% and 78.6%. It might indicate that it's still within a retracement phase. And if we take a look at the rejection yesterday on Monday, although it was a quiet day on Monday because of the President Day in the US, so the US market was actually closed, we see the US dollar actually struggling to gain above the 104. So right now we would consider the 104 level as the key resistance level for the dollar index here. Any drop moving away from the 104, that would actually indicate a completion of the US dollar correction. So that might be the end of the dollar strengthening that we have actually seen pretty much in the month of February. In other markets, we've got the pound USD, the sterling. This is rather flat. It is still range bound from December between 1.19 to 1.2450. The current support is at 1.2. And if we take a look at the movement early this week, it is kind of hovering above 1.2 at this point in time. If 1.2 holds as a support, then we might actually see a move higher towards 1.2150. But if we lose that 1.2 support, then we are likely going to track lower towards the range closer to 1.19. On to the Euro USD, this one here again, it is currently trading at around 61.8% Fibonacci retracement. That's located at around 1.07. In terms of support, we do have 1.0660, and then followed by the 78.6% retracement at 1.06. The current condition is that on the daily time frame, this is within the Ichimoku cloud, so we do expect a little bit more of a choppy market condition, a little bit more of a range bound market condition at this point in time for the Euro USD. The range for intraday trades would be between 1.0660 to 1.07 for the Euro USD. So expect the Euro USD to be a little bit more in a range bound market condition intraday wise, awaiting the FOMC meeting minutes. All right. Moving on, next we've got the Aussie USD. The Aussie USD, this one here, it's currently trading just right around the 69 cents. We do have that range in terms of key levels. We have 69 cents, we've got 70 cents and 71 cents. If we see a movement back above 69 cents, then we might actually track this one towards 70 cents. But the current condition, if this one continues to be traded below 69 cents, then we actually have support at 68.50 and 68 cents. In terms of the trajectory for intraday trades, it will be in a range bound market condition. We've got the pivot at 69 cents. The overall stance for the Aussie USD is that we have seen this transition above the Ichimoku cloud, so we do have a little bit more of a bullish momentum building up for the Aussie USD, but the overall trend is pretty much non-existent. This is in a sideways range bound market condition. Okay. Next up, we have the dollar Japanese yen. So dollar Japanese yen, mimicking what the dollar index does, it is being capped currently at 134.50 with 133.50 as a support. We do see a potential for this one to create a little bit more of a rising wedge on the daily time frame. So we do have a little bit of a potential rising wedge on the daily time frame. So right now, in terms of potential market range, we do expect a little bit of resistance to come in strongly. 134.50, 135. If price continues to fail at 135 and breaks lower, it will need to break below 133.50 to initiate a little bit more of a correction in the dollar Japanese yen. In terms of daily, this is currently traded within the Ichimoku cloud, so we do expect a little bit more of a range bound market condition between the range 133.50 as a support and 134.50 as a resistance intraday wise. All right, so leading up until the FOMC meeting minutes, we might actually see that rejection come in at 134.50. We might actually track this one lower initially towards 134, and then it could potentially lead lower towards 133.50. But in terms of any significant range breakout, it does need to break either above 134.50 or below 133.50 to initiate any strong direction in the market. But until that happens, I think the market is awaiting what the FOMC meeting minutes, also the manufacturing and services PMI on Tuesday, as well as the personal consumption expenditure on Friday.